The cash flow statement is one of the three main financial statements that tells a company how much cash it has on hand for a specific period of time. While the income statement is meant to show how much a business is earning or spending, the cash flow statement tells you a different story about the business performance. It tells you where the cash is coming from and what it's being spent on. There's a lot to be said about a cash flow statement, but here are a few simple points to keep in mind. Number one, the cash flow statement's main job is to summarize the movement of all the cash that comes in and goes out of the business. Number two, a cash flow statement is used to oversee how all the cash in the company is being managed in terms of assets, liabilities, and equity, and to understand where you're actually generating cash from. Number three, the cash flow statement is just a supplement to the other two main financial statements, the income statement and the balance sheet. Alone, it doesn't give you a complete picture, so you have to use all three to get a really accurate understanding of how the business is performing. A cash flow statement has three main components: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. The cash flow from operating activities is arguably one of the most important sections to pay attention to because it shows you where a company is actually generating cash from through its operations. The operating activities in a cash flow statement are meant to indicate what sort of cash flow needs a company has to carry on its day-to-day operations. So that would include the revenue from goods or services, inventory expenses, salaries and wages, marketing expenses, and software costs. Investment activities is all about the cash earned or spent on investments. In other words, it's outside of the primary activities of the company that it does to make money. Investing activities can include stuff like the sale or purchase of a building or manufacturing equipment, giving out loans to a customer, or even acquiring another business, as long as these aren't the primary activities of the business. And lastly, financing activity refers to the cash that is received from investors or banks, or the cash that is returned to those parties. These financing activities are usually referring to things like issuing shares or taking out a loan or even paying interest on that loan. The main idea here is to look separately at how a company raised its money versus how it's actually spending its money. So how do we actually prepare a cash flow statement for a business? Well, there's two main ways: the direct method and the indirect method. The direct method is exactly what it sounds like. It's direct. In the direct method, a company simply keeps track of all the cash that goes in or out of the business and then uses that data to prepare a statement of cash flow. In a regular cash flow statement, whether it's prepared through the direct or indirect method, any number that's in a parentheses indicates that there's an outflow of cash from the business. So for example, let's say on a statement of cash flow, you see a $10,000 next to the inventory line in parentheses. That means that even though the business actually bought $10,000 of inventory, that purchase required a $10,000 outflow of cash. On the other hand, any number on the cash flow statement that doesn't have a parentheses indicates an influx of cash into the business. So for example, if you saw $100,000 next to the machinery line on a cash flow statement, that might indicate that they sold machinery for $100,000, and so $100,000 came into the business. So at this point, it's probably important to understand in the accounting world, cash and profit do mean separate things. Most big companies use a method of accounting called accrual accounting as opposed to cash accounting. And in accrual accounting, we focus on when revenue was earned, regardless of when the cash was actually received. So let me try to explain the difference with an example. We know that in accounting, not every single transaction includes cash. Say, for example, somebody makes an order from me and I decide to ship them $10,000 worth of inventory. Now they owe me $20,000, but just because I've earned that revenue since I shipped them the inventory doesn't mean that I've actually collected it right away. I might have to wait 30 days. If you're not totally sure about what cash versus accrual accounting is, you can check out this video, which will explain it a little bit further. And so in these situations, it's easier to use the indirect method to prepare the cash flow statement. The indirect method of preparing a cash flow statement allows a business to look at all the transactions on its income statement and make adjustments for the non-cash items. This process allows them to selectively remove any transactions or adjust for any transactions that didn't have a cash impact. Let's say that in a given month we sold $10,000 worth of inventory to a particular customer, but they're not going to pay us for another 30 days. So during that month, our accounts receivable balance will increase by $10,000. So we can show that the change in accounts receivable indicates that that transaction didn't have a cash component. It indicates that while the revenue was actually recognized in the income statement, the cash has not actually changed hands yet. Basically, with the indirect method, you can use your income statement and the change in certain balance sheet accounts to create your cash flow statement. Under the direct method, though, you would have to separately keep track of every one of those cash transactions and add them up together to create your cash flow statement. When using the indirect method, the calculation of cash flow from operating activities begins with the income statement. Adjustments are applied to your net income number to finally arrive at your cash flow from operations. For example, say your accounts receivable balance decreases by $20,000 during a certain period of time. That means that $20,000 of cash has entered the business because your customers are actually paying off their debt. So even if there was no activity during a certain time period and the net income was zero, just because the customers are paying off their receivables, there's going to be an increase in cash from operating activities. Following the same logic, if there's an increase in receivables during a certain time period, that amount would actually have to be deducted from net income, because while the revenue was recognized, there's no cash that was received yet. The same thing applies to balances like inventory or accounts payable. Say you spend $50,000 to buy some more inventory, that's not going to show up on your income statement until you've actually sold it. However, in the meantime, that $50,000 outflow will show up on your statement of cash flow. Basically, in the indirect method, you're using certain changes in balance sheet accounts to indicate how much cash went up or down. So which one is better for cash flow statements, the direct method or the indirect method? Well, one isn't necessarily better than the other. In terms of the generally accepted accounting principles, or GAAP, for most jurisdictions, both methods are equally acceptable. Most businesses do tend to use the indirect method because it makes it easier to see the relationship between the income statement and the balance sheet. All three together, the income statement, the balance sheet, and the cash flow statement, provide the most clear picture of a company's financial position and health. So how do all three of these statements work together? Businesses use the information from the income statement and from the balance sheet to be able to create their cash flow statement. The income statement provides information about how much money a company has earned, and it's used as the starting point for preparing a cash flow statement. The balance sheet, on the other hand, is a snapshot of what a company's financial position looks like in terms of assets, liabilities, and equity. So you need all three together as the formula to be able to understand the truest picture of a company's performance. This is such a crucial part of business that if you want to learn a little bit more about the income statement or the balance sheet, I recommend you watch both of our videos on those, which I will link in the description below. The statement of cash flow is such a powerful tool that anybody with a keen financial eye can use that to understand how a business is actually performing. While a company might look healthy based solely on its income statement, at the end of the day, if you're just losing cash, you can't run a business very long. Typically, the more cash you have available for a business to run, the better it is, because cash is king. Now, this isn't an exact rule. Sometimes a negative cash flow is actually part of the company's strategy to be able to grow aggressively. Similarly, a positive cash flow is not always a good thing because it might indicate that a company is taking on a lot of debt or that they're just selling off parts of their business. So positive cash flow might not be so positive after all. So let's sum up with some simple ideas. The cash flow statement is a measure of a company's health and its long-term outlook. The cash flow statement determines if a company is going to have enough cash to be able to cover its expenses or not. And the cash flow statement helps to forecast future cash flows of the company so that they can better strategically plan for things. So all in all, a cash flow statement is a very powerful financial tool and very helpful in understanding a company's financial health. And together with the income statement and the balance sheet, it creates the financial statements of a company. So that was a beginner's guide to a cash flow statement. Thank you so much for watching. And if you want to be able to see more useful stuff like this, please like it, share it, and subscribe. For now, take it easy.